Okay, good afternoon, class. And welcome to ICAN AAAF, that is Advanced Audit Assurance and Forensic class online for Equity Professional Limited. Uh, we are looking at chapter 14 today, which is reporting. Now, chapter 14 is one of the topics that is contained in the new ICAN syllabus that came into effect, that is going to be tested or that was coming into effect in this diet, that is November 2025. Okay, so we'll be looking at reporting today. So I'm trying to get to that point, to the chapter, so that we can start from there. All right, so just give me some few minutes. We'll soon be there now, or seconds. We'll soon be there. Now, essentially, reporting is the last stage of the audit engagement cycle. All right. So what does that mean? So when you go for an audit engagement in a client office, once you are done with the engagement, the last part of that engagement is known as the reporting. You are going to write a report on what transpired during the audit, which you are going to communicate to the responsible party, okay, that is those charged with governance, that's the management, as well as the shareholders of the company, okay. So that's what we're looking at. So in this chapter, we'll be looking at some of these aspects. That is reporting. We'll be looking at something that has to do with execution gap. We have looked at that in chapter 4. So we are going to skip that, okay? It's just a repetition here. We are going to skip that. So we are going to look at reporting. So number one, what is reporting? Reporting is covered under ISA 701, 700, 705, 706. Those are auditing standards that speak to reporting, okay? Those are the standards that speaks to reporting. So what is audit report? Audit report is the last stage of an audit engagement where the auditor is expected to communicate in writing, okay, all the observations that he gathered in form of what? Audit evidence during the course of what? The engagement, okay? So what we mean here is that once the report is done, once the engagement is done, the auditor will present a report to the management. So you're going to present a draft report to the management, and in that report, the report will contain his opinion. He's going to express his opinion on whether the financial statement that he or she has audited shows a true and fair view. All right. That is basically what the audit report is all about. That is a report that shows the summary of all the information obtained by the auditor and how he's been able to express his audit opinion as per that particular engagement. That is audit report. Now, if you go back to the audit report, you see that if you look at the audit report, there is a phrase there that is common, that's commonly used in that audit report. And that phrase is known as what? The true and fair view. Okay, the true and fair view. Now, that's why you're going to write audit report, you're not going to see the financial statement shows a true and fair view. Now, this true and fair view, you cannot break it. You cannot separate and say, let's talk about true. What is true? What is fair? Is a phrase, and the phrase goes together. You cannot try to interpret it individually. You have to look at it from that point of what? A phrase, true and fair view, right? Now, if you're to be in America, right, you'll be looking at financial statements present fairly in all material respects. That's what you have seen there. The financial statements present fairly in all material respects. But because we're in Nigeria and our syllabus is Nigerian syllabus, is for Institute of Chartered Accountants of Nigeria. So what we have in our audit report is true and fair view. So we are going to look at what does it mean when you say the word true and fair view. Now, true and fair view can connote any of these five interpretations. So they can ask you an examination. What is the meaning of true and fair view? What they expect you to write is to explain all of these connotations you want to look at now. Okay, you should not leave anyone out of it. So the word true and fair view, like I said, can depict any of these for the number one, that the financial statement comply with all relevant legislation and accounting standards. That is complies with all relevant legislation and accounting standards. You know, I told us that the main duty or the main responsibility of an auditor is to ensure that the financial statements are prepared in line with applicable financial regulatory framework. Okay? That in line with what? Applicable financial regulatory framework. That is the main. The topic we are discussing is reporting, chapter 14. The topic we are discussing, reporting. That's the topic we are discussing. Yeah, Charity, any question? I can see your hand up.
Yes, sir. So it's not a question or it's an observation. I started the class with you, but to be sincere, I'm not even understanding anything. And I think you are very fast.
Share the class with me when.
Now,
I've not said anything now. I only talk about reporting.
and you
I've not
did a
said
lot of
anything.
things I've not understood it.
I just pay attention. And again, this class is recorded. So even if you don't get it now, you have access to the recording. You can listen to it over and over again till you get it.
Choose the time to go back to it. You have another class.
I just listen now. So where did you miss it? Where do you want me to talk about again?
Can you
What did you
repeat
not get?
that? We are going to treat a topic that, that was introduced
I cannot hear
newly.
you, Madam Charity. Oh.
Really?
Be a little bit audible, please.
Okay, sir, can you hear me now?
Better.
I'm saying that this topic is introduced newly and will be tested in this.
Eh,
Talking about
so so where do you want me? Where have you not gotten me? Did you just join now? Or you were there when the class started
uh,
today?
yes,
You just joined now. I can't hear you. Madam Charity. Okay, let me not waste because we don't have time. Before you know it now, this class, before we joined, there was a session I was on, so that will not also intrude into other people's time. So I'll recap what I've just said. I said this topic we are looking at chapter 14, which is reporting. We are looking at chapter 14, which is what? Reporting. And I said reporting is the last stage. Look at it here. Reporting is the last stage of an audit engagement cycle. And I said, what do we mean by reporting? I said reporting has to do with the summary of the activities that have been performed by the auditor, okay, as a result of the information is been able to obtain from the client financial statement, so as able to what? Form his opinion whether the financial statement complies with applicable financial regulatory framework. That is what reporting is all about. Nobody's going to ask you what is reporting, but they can ask you some of these aspects that we are discussing. And I said that is the definition of reporting. Now, in reporting, we have an aspect known as what? True and fair view. I said that you should not look at responses to explanation gap. Why? Because we have looked at that in chapter 4 under auditor's liability and responsibility. So that's why we move on to uh, true and fair view. Now, if you are very conversant with the auditor's report, you will agree with me that there is a phrase that is common with every auditor's report, and that phrase is known as what? True and fair view. Now, and I said that you cannot divide this word. You cannot divide it. You cannot say let's interpret fair separately. Let's interpret true separately. You have to know them the way they are as a phrase, which is what? True and fair view. So when you hear the word true and fair view, I also said that if you are to be in America, you might not see the word true and fair view. What you are going to see is what? The financial statement present fairly in all material respects. The financial statement present fairly in all material respects. Okay. So, but because we are not in America, we are in Nigeria, we are going to confine ourselves to what is obtainable in Nigeria, which is what? True and fair view. So when you come across the phrase true and fair view in an auditor's report, what we want to discuss now are the possible meanings of that phrase, true and fair view. Number one, when you hear the word true and fair view, it means that the financial statement presented to the auditor complied with what? All relevant legislation and accounting standard. That is, remember I said it, that the primary duty or the primary responsibility of an auditor is to ensure that financial statements are prepared in line with applicable financial regulatory framework. That is the first job the auditor needs to do. Not to express an opinion, not to qualify an opinion. That's the first thing he needs to check. Okay? Now, because if the financial statements are not prepared in line with applicable financial regulatory framework, then what are we looking at? That means we don't have a basis for what? For benchmarking. There's no basis for what? Benchmarking. There's no criteria. That's what it means. Then another meaning, when you read the word true and fair view, it also means that when preparing the financial statement, they have used accurate figures or best possible estimate. What does that mean? So in accounting, if you go back to your IAS 8, talks about prior year adjustments and accounting policies and the likes, right? You have what we talk about estimates there. Okay. So it is allowed for you to use estimates in your preparation of your financial statement, especially when the figures are not readily available. But you have, for instance, you have figures for January, February, March, April, May, June, July, up to November. You don't have that of December. Because you don't have that of December, does not mean that you cannot estimate what December will be because you have the previous month available. By the time you juxtapose it, right? By the time you extrapolate it, you are going to arrive at possible what the figures will be in December. Yes, the figures are not actual. They are estimated. Okay? But what the law says is that there's no crime when you estimate. What we are saying is that any estimate you give should be an estimate that is what? That is realistic. You must give what? A realistic estimate, or we call it best possible estimate. Okay? Number three, when you hear the word true and fair view, it also means that the financial statements have been presented meaningfully and all disclosures have been made as regards to all information. That is, the financial statement has been prepared in the order, in the template that's supposed to be. Remember, if you go back to your IS1, that is presentation of financial statement, that is going to be replaced with IFRS 18 in 2027, right? It states that how you present financial statement. So when you see the word true and fair, it also means that they have prepared financial statements in the order as stipulated in the International Financial Reporting Standards, and that all necessary disclosures have been what? Have been made. All right. When you hear the word true and fair view again, it means that the avoidance of bias, distortion, and manipulation of figure, that is, when you look at the financial statement, they have not what? Distorted any information or figures, and they have not manipulated any figure as well. That is what it means. Okay. Then lastly, when you hear the word true and fair view, it means that no concealment of material misstatement. That is, they have not hide or they have not hidden any vital information to the users of the financial information. So when they ask you an examination, you come across a question that talks about what do you understand by true and fair view. What the examiner expects you to write is to discuss all of these five connotations, these five interpretations. Don't discuss just one, don't discuss just two. Endeavor to discuss all the five. All right? Are we together? Any question? Any question? Then the next thing we want to look at is, let's look at types of audit reports. Basically, there are two types of audit report, two types. You have the unmodified audit report, okay? And you have the modified audit report, or we call it, you have the unqualified audit report, and you have the qualified audit report. Okay? When you say the audit report is unmodified, what does it mean? Now, before I go on to explain it, I need us to understand something. That the way some terminologies are used in advanced audit, assurance, and forensics is not the same way they are used in normal English. For instance, when I tell you in English that you are qualified, it means something that is what? That is positive, something that is good. However, when I tell you that your report is qualified in advanced audit assurance and forensic, it means something that is what? Negative, or something that is what? Something that is bad. Okay? So I need you to have that at the back of your mind. So when you talk about unmodified audit report or unmodified audit opinion, we are practically saying the same thing. What it means is that the auditor, what that means is that the auditor has been able to express an opinion that the financial statements are presented in all material respects in accordance with applicable financial reporting form. The auditor does not have any reservations, does not have any issues with how the financial statements have been what have been presented. That's what it means. Okay? That is, the auditor does not have what any reservations about the financial statements presented. Why? Because they have been prepared and presented in line with applicable financial reporting framework. I hope we are together. Now, the second type of audit report is the qualified audit report. Okay? The other one is what? The qualified audit report. What do you mean by qualified audit report? Now, qualified audit report, I'll go there now. Let me go there so that you can see. They will not be saying, where are we? Where are we? This is it. The qualified audit report, or we call it the modified audit report, is when the auditor expresses or the auditor has what? Reservations about the what? Financial statement. Okay? Modified audit report or modified audit opinion, of course, where the auditor has what? Reservations about the what? The financial statement presented. Maybe they are not represented in line with applicable financial regulatory framework. That is the second, that is what that means. So you need to note what you have really learned now, that there are two types of audit reports. You have the unmodified audit report and you have the modified audit report. That is clear, right? Now you can further divide the modified into three parts. You can further divide the modified into what? Into three parts. Okay. I'm going there. I'm coming back to this one. Don't worry, I'm going to come back to talk about this. I need to go back to where we are. All right. This is it here. There are three types of what? Modified audit report. Number one, you have the qualified opinion, you have the adverse opinion, and you have the disclaimer opinion of opinion. Okay. Now, what do you mean by qualified opinion? When you say something is qualified opinion, what that means is that the financial statement would have been what? Adjudged true and fair. I take it again. The financial statement would have been adjudged true and fair, except for an aspect in the financial statement that does not allow for that to be so. So when you say a qualified opinion, means that you say that, oh, the financial statement shows a true and fair view, except for that is, there is something that will not allow that to what? To pass. Except for. If not for the except for, you will have called it what? An, an unmodified audit report. Without that except for, it will have been what? An unmodified audit report. But because of the except for, that means there's an issue. There's something with the audit report, there's something with financial statements. So you don't issue what? A qualified audit report. So before we go ahead to explain the other two, let's look at what are those reasons or circumstances or factors that can make the auditor to qualify his opinion. What are those factors, circumstances, okay, that can make the auditor to qualify his audit opinion? Let's look at them. Number one, there are two main reasons that can make the auditor to qualify his audit opinion. Two main reasons. Number one, disagreement or misstatement. Number two, limitation of scope. Then you call it what? Misstatement or misstatement. And number two, limitation of scope. So what's the difference between the two? When you say there's a misstatement, it means, number one, it could either be any of these reasons. Number one, that the financial statements have not been presented in line with applicable financial regulatory framework. That's number one meaning. When you say the financial statement is what? Is misstated. Number two meaning, that the financial statement has not been, information have been what? Or accounting policies have been what? Have been applied erroneously. They have applied accounting policies wrongly. That could lead to what? Misstatement or disagreement. Number three reason is where there is inadequate disclosure. Where there is what? Where there is inadequate disclosure. Disclosure is notes to the account. They did not put notes to the account. Or some information are not in the notes to the account. We call it what? Misstatement. These are some of the reasons that will qualify for what? The auditor to give what? A misstatement. When we go to say, we use the word misstatement. Now, you need to also understand that this misstatement can be in two degrees or in two forms. This misstatement can be what? In two forms. Number one, it could be in form of what? Material but not pervasive. Material but not what? But not pervasive. What do we mean by material but not pervasive? So let me give an instance. So you review the financial statement. Everything is fine with financial statement, from the statement of financial position to the statement of profit or loss, under comprehensive income. But only one area had an issue, and that area is what? Inventory. Possibly they did not apply the right accounting standard for inventory. What do I mean? So remember in your IAS2, you talk about various methods of computing what? Your inventory, costing your inventory. But out of these various methods, only two are what? Are approved or are recommended. That is either you use what? First in, first out, or you use weighted average. Either you use what? First in, first out, or what? Weighted average. Now, in case, let's say you look at financial statement and you ask the management, how did you arrive at your inventory, the costing of your inventory? Let's say we use last in, first out, or we use standard costing, okay, or we use base stock. If they use any other method of costing outside FIFO and weighted average, that means they have misapplied the accounting standard. The other will say that, oh, financial statement shows a true and fair view, except for, that means if not for that issue with inventory, the author will have given the financial statement the green light that everything is perfect. So that's what we mean by material but not pervasive. Yes, that thing exists. That issue exists, but it's not pervasive, means that it does not affect every other aspect of the financial statement. It's only limited to inventory. Okay? But when you hear the word material and pervasive, what it means is that that issue did not just stop at only inventory. A couple of other transactions or account codes, okay, are also having the same challenge or the same challenges. Okay? So we say that when you have challenges that are found or that are common, right? You say it is what? Pervasive. You say what? It is what? It is pervasive. I hope you are getting me. So when you hear the word pervasive, it means something that is common, that has spread everywhere. But when you hear look at it here, look at it, material, but not pervasive, means that yes, something is wrong, but it's only limited, does not spread. It's only on one aspect. But when we look at this one, material and pervasive means that that issue exists, but it's common. It's affecting more than one area or one aspect of the financial statement. It's common in the what? In the financial statement. So you said what? Material and what? Pervasive. To further explain what we mean, let me use another example. How many walls? Let's say that a house has what? It's rectangular in shape. It has four walls. Okay, four walls, right? Now, if there's a crack in one of the four walls, the walls of the house, if there's a crack in one, can you say that that crack in that one wall will lead or could lead to the collapse of the entire building? The answer is no, or the entire house. That is, there was a major crack in one of the walls. There are four walls in a house. One of them is badly affected. There's a crack there. That crack on that one wall, can it lead to the collapse of the house? The answer is no. The answer is what? No. One crack on a wall cannot lead to, the only thing that can happen is that particular wall will collapse, but it will not affect every other one. All right? That's one way to look at it. But when you have a crack in not just one, but all the four walls, one, two, three, four, all the four walls had cracks on them, automatically that house will what? Will crumble. So when you have that crack on all the four walls, we call it what? Pervasive. You call it what? Pervasive. That is, it is found everywhere. It is common. Do you understand? So when you have issue with misstatement that I am explaining now, that is, it only affected inventory. You say that it is material but not pervasive. It is material but not what? Pervasive. So you issue what? A qualified opinion. Or you say an except for. You say that the financial statement shows a true and fair view, except for. Except for. Do you understand? Now, but let's say you have that issue, you have that misstatement, not only in inventory, it affected revenue, it affected assets, it affected liabilities, it affected expenses. All of them were affected. We now say that the issue is what? Is material and what? Pervasive. So the author will issue what? An adverse opinion. The author will issue what? An adverse opinion. So the author will not say that as financial statements show the truth. The author will say that he could not form an opinion at all. The author cannot form an opinion at all. So issue what? An adverse opinion. Now, please note, anywhere an adverse opinion is issued, what it means is that there's a need for that audit to be done again. You have to redo the audit. Why? Adverse opinion is the worst type of audit report that can be issued. Is the worst type of audit report that can be what? That can be issued. Well, anytime you issue adverse report, adverse opinion, you must do the audit all over again. I hope that is clear. The second factor that can lead to qualification of audit report is limitation of scope. What do you mean by limitation of scope? From the word limitation, that means the auditor is found in this situation. Number one, if the auditor is appointed very late. What do I mean by very late? There's supposed to be an audit in the company around December, but they only appointed the auditor in November. That is it's too close. So the auditor was appointed very late. So the auditor will not be able to cover much ground. It's going to suffer from what we know as what? Limitation of what? Scope. That's number one. Number two is when you talk about limitation of scope is that where the auditor is not allowed or is prevented from carrying out some of his audit testing and procedures. One of an audit procedure is stock count. The auditor wanted to carry out stock count or inventory count. And the management said that we don't have time for that. We don't have what? Time for that. When that happens, it means that the auditor has not been allowed to carry out his what? Perform his audit procedure. So he has suffered from what? Limitation of what? Scope. Now, if that limitation of scope is limited to an aspect, let's say it's affected only inventory. That is, the auditor will not carry out inventory count. But every other thing about the financial statement is fine, except for the inventory. The auditor will issue what? A qualified opinion, known as what? Except for. The auditor will say that the financial statement shows a true and fair view, except for the inventory balances that cannot be verified as a result of what? You couldn't perform inventory count. But when you now have the limitation not only on inventory, it affected revenue, it affected assets, it affected liabilities, it affected expenses, it spread everywhere. The author will issue what? A disclaimer of opinion. The author will issue what? A disclaimer of what? Opinion. The author will issue what? A disclaimer of what does that mean? What that means is that the author will not be able to form an opinion. Why? Because it does not have access to what? Information. Necessary what? Information or sufficient and appropriate what? Audit evidence. I hope that is clear. Any question?
Yes, sir. I have a
Please,
question.
please ask your question.
Sir, concerning the material, I understand the persuasive part, but the material
Yeah.
aspect, are we
Yeah.
referring to the reports that the auditor is giving, or we are referring to the aspect he picked that is having issue on? So I just want the clarification on the
Very well.
material.
We are looking at the aspect he picked. We are looking at the aspect that he has issues in, like those aspects I made mention of: inventory, um, assets, non-current assets, current asset liabilities, any of them. That's not the audit report. It's on the aspect that he picked. How are you to answer your question? Are you able to answer your question? Yes, Charity, I'm with you. Ask your question.
Hi, sir. Sir, can you hear me?
Go ahead, loud and clear.
Okay, sir. When you talked about disclaimer opinion, it was
Yes,
more like a different something than what I know. You know that time they were teaching us case study. They say disclaimer is the auditor is writing to make sure that a third party do not use the information provided
great. That one is
by
different. That one is
or
different. That one is
okay,
different. That
okay,
one is not as per audit report. What that one is saying here is that whoever uses that information does so at his or her own risk. That's what you are saying, right? Clarity.
yes, sir.
What you are saying is that whoever relies on that information does so at his or her own risk. That what you
Yes,
call disclaimer. That one is disclaimer opinion. Okay? The auditor will give what?
yes,
Will give a disclaimer on his report. That one is different. This one
sir.
is talking about the audit report. That one is talking about whoever wants to utilize that information. But this one is talking about the audit report. So there are two different things. In case study, yes, you can call it disclaimer. But this one is disclaimer of opinion as a type of audit report or audit opinion.
Mm.
Is that clear?
Yes, it's clear. But sir, is there how you can explain that disclaimer opinion to me again?
Just did now. See, let me explain it again.
Okay, sir.
This is it. When we talk about disclaimer of what do we mean? The auditor is not able to obtain sufficient, appropriate audit evidence as a result of what? Limitation of scope. That is not limited to only one aspect of the financial statement, but almost every aspect of the financial statement. It has spread over. It affected revenue, it affected cost of sales, it affected non-current assets, it affected current assets, it affected liabilities. It also affected expenses. So in that instance, the auditor will issue a disclaimer of opinion. Why? Because it cannot even form an opinion at all. Because of what? It could not have access to necessary information. Is that clear?
Yes, sir. Thank you.
All right. Any other question? So I've used that opportunity to explain the types of audit reports or audit opinion. We have explained qualified opinion. When they ask you in an examination, you know how to answer it now. If they ask you something on adverse opinion, you know how to answer it also. If they ask you about disclaimer of opinion, you know how to answer it as well. Those are the three types of audit reports that we have under the what? Modified audit opinions. Are we together? Let's go on. So most of these things I've said now, they are already in this material. Because I am not reading the material in verbatim. That's why you see it when you read the material, all what I've said, you see it there. Everything is written in black and white. Okay? But I'm not reading it in verbatim. I'm explaining it. So that is it now seems as if I'm summarizing what you have in this particular chapter. Okay? We are coming back to some of these aspects. Let's go on. There's an area I want us to look at before we proceed. Now, since you have gotten down that you have that understanding of audit report now, that is, there are two types of audit report. We have modified and we have the modified. The modified is further divided into three: qualified, disclaimer of opinion, and adverse opinion. And I said that the adverse opinion is the worst type of audit opinion. Anytime it is issued, you have to carry out the audit all over again. All right. The next thing we want to look at now is the content of an what? Audit report. The content of what? An audit report. Now, before we go to the content of audit report, I want us to look at something above, just above. Now, what the auditor can reach his audit opinion, the auditor will need to what? Evaluate the following. Number one, you need to be sure that he has obtained sufficient appropriate audit evidence as to whether financial statements are free from material misstatement. He has to obtain what? Sufficient appropriate audit evidence. Okay? Number two, he has to also ensure that there are no uncorrected misstatements, okay, whether individually or when they are what? In aggregate. He has to ensure that there are no what? Uncorrected misstatements. All misstatements have been what? Have been corrected, and that they are not material. Whether individually means if they stand alone. In aggregate here means if you sum them together. That it is not one. If it's more than one, you sum it together. Okay, that's what we mean by in aggregate. Then number three, the author needs to also ensure that financial statement gives a true and fair view. Then you also need to be sure that the financial statements are prepared in accordance with the relevant financial reporting framework. Right? Then he also needs to know that before he reaches his opinion, the author needs to also know the financial statements adequately disclose the entity's significant accounting policies. Entities accounting policies are what? Are stated or disclosed. Then you also need to evaluate whether the significant accounting policies are appropriate and consistent with the relevant financial reporting framework. What do you mean by appropriate or consistent or inconsistent? Now, what we mean is this: you use an accounting policy last. What's an accounting policy? Those are policies, or those are information that the company use to prepare their financial statements or to guide their financial reporting. We call it accounting policies. Now, let's say one of the accounting policies is the depreciation policy. Now, last year you used reducing balancing method of depreciation for your fixed asset register or asset schedule. This year you are using sum of digits method. That is not consistency. Okay? When you see something inconsistent, what you used last year, what you performed last year, what you are still going to do this year. You're supposed to have maintained the reducing balancing method that you used last year, this year. Not to change it to sum of digits method, even though sum of digits method is another type of depreciation. But what the law says is that if you have applied any accounting policy, it should be applied what? Consistently. It's one of the conventions in what? In accounting, consistency. That is, you must ensure you apply your accounting policies consistently. Okay? Then the auditor also needs to ensure that they use what? Accounting estimates that are reasonable. I've explained what that one means before. Okay. Then the auditor needs to also evaluate the information in financial statements is relevant, reliable, comparable, and others. So what do you mean by relevant? That is, all the information you have in the financial statement all supporting documents, they are what? They are related to the same organization. So that you're auditing ABC Limited now, then the invoices you are seeing belongs to XYZ. That is not relevant. The invoice should also be ABC invoices. You should speak to the company ABC, not the invoice of XYZ. That will mean by relevance. Reliable means that you are sure of the information that you have. That is the information that you have. You can rely on it. You can plan, you can make decisions out of it. When you talk about comparable, you see that a typical financial statement has the comparative figure, the previous year and the year under review. If you're auditing 2025 now, you're going to see beside it 2024. That's comparable. And when you talk about understandable, means that anyone that picks the financial statement and looks at the notes to the account is able to understand how the note relates or speaks to the what? The financial statement. All right, I hope that is clear. Then they also need to evaluate that the financial statement provide adequate what? Disclosures. Okay. All of these are what we need to do before you arrive at what? Audit opinion. All right. So let's look at this aspect. Now, if you look at the typical audit report, there was a year they asked a question, I think about 2 or 3 days ago. They asked the students to arrange some of those information in the order that is supposed to appear in the audit report. And that question was question number 2 or question number 3. I saw that question. All right. So when you are giving a question like that, if you have not understood what are the information that is contained in an audit report, that question will not be easy in that way. But once you have understood the content of a typical audit report, if you saw that kind of question, you will just be smiling. You'll be happy to attempt it. So when you look at the typical audit report, what are those things that you need to look out for? What are those things that are contained in a typical audit report? Number one, the typical audit report will have what? A title. It must be that this is the audit report of ABC Limited. Okay? Then it has what? Addressee. It must be addressed to somebody or to some set of people. Or this report is addressed to the shareholders of ABC PLC. Or this report is addressed to the what? To the management of ABC Limited. It must be addressed to somebody. Then it must contain an introductory paragraph that is, this audit report is for ABC Limited, a company that is in the manufacturing of safety gadgets, company that is responsible for the manufacturing of what? Electronics, company that is in charge of what? Importation of what? Gadgets. You must give some form of what? Introductory paragraph for the year ended 31st December 2024. That's what you mean by what? Introductory paragraph. Then it must contain a statement of management responsibility for the financial statement. That is, you are going to state, there should be a paragraph that says that these are what the management is supposed to do as regards the what? The financial statements. And you're going to list them. One of it is that they are responsible for the preparation of financial statements. Another one is that they are responsible for putting in place sound internal control system. And they're also responsible for prevention and detection of fraud. Those are some of the responsibilities of the what? Of the management as regards what? The financial statement. Auditor's responsibility. The auditor's responsibility is a paragraph in the audit report that explains the role of the auditor. And the role of the auditor is to ensure the financial statements are prepared in line with applicable financial regulatory framework. In line with what? Applicable financial regulatory framework. The next thing we are going to look at is what? Auditor's opinion. Now, this is what you need to be careful of. Now, if the audit report is unmodified, this will be appropriate. Auditor's opinion. I take it again. If the auditor's opinion is what? Is unmodified, that is, the auditor doesn't have any reservations, you leave it as this, auditor's opinion. But if the auditors have some reservations and he has issued a modified opinion, you are going to state it here. Modified auditor's opinion. I take it again. If the auditor has some reservations about the financial statement that he has just audited, you are not going to maintain auditor's opinion. You're going to write modified auditor's opinion or adverse auditor's opinion or disclaimer of opinion. Those are what you are going to put there, depending on the level of what? Modification or qualification. I hope we are together. And this next one, other reporting responsibilities. What this one means is not all the time. What this one means, if your auditor is auditing a company that is a private company, this may not be applicable. If you're auditing a private company, this may not be applicable. But if you're auditing a company that is a PLC, other responsibilities means maybe the company has been involved in what? Corporate social responsibility. Okay? If the company has been involved in corporate social responsibility, you have to state it, you have to put it here. All right? Then other thing you're also going to put there is if in the course of looking at the audit report, remember the audit report is contained in a document known as what? Annual account and report. You will find the audit report in a document known as what? Annual account and report. That's why you have the audit report, right? What we are saying here is this. If you look at the annual account and report, there are other information that are contained in the annual account and report. One of them is what? The chairman's statement. The chairman's statement is a statement that is contained in a paragraph that summarizes the activity of the organization by the chairman. It summarizes what? The activities of the organization or possibly the profit the organization has made in the year under review in that paragraph. So what am I saying? If the chairman has stated that we made 1 billion in his chairman's statement, when you look at the financial statement, you can only see 500 million. That means the information is not what? It's not consistent. So one of the things the auditor needs to do is to ensure that when he's writing his audit report, he must ensure that other information that is contained in the annual account and report, they are what? They are consistent. That is what he's going to state here. That is, he has reviewed other aspects of the financial state, other aspects of the annual account and report, and all information is consistent. Use their seal is the seal that they are using now, the audit firm seal. Once you become a chartered accountant now and you have your own firm, right? They will give you the seal. For instance, let's say I have an audit firm, Adebayo and Co. I will have the seal. Do you understand? So if you are the auditor, you will have the seal. Your seal is also similar or is the same thing as what? Your signature. Okay? Then you have to put the date of the audit report. Please note, the date of the audit report must not be earlier than the date the financial statements are signed. I take it again. The date of the auditor's report or the audit report must not be earlier than the date the financial statements are signed. Let me explain. Let's say financial statements are signed on the 25th August 2028. I mean 2025. 25th August 2025. The auditor's report, the date on the auditor's report cannot be April 5, 2025. It cannot be. It can only be a date after 28th August 2025. That is, it can be 29 August 2025. It can be 30th September 2025. It cannot be any date earlier. I hope you understand. Then you have to put the auditor's address where the audit firm is what is located. All right. Are we all together? Any questions so far? Question, comments? Question, comments? Observation?
Sir, the
Please go ahead.
other reporting
Responsibility.
responsibility that you said
Yes.
is it talks about the activity of the entity. Is it the auditor that is going to write it, or the management is the one that will give it to him?
Okay, before I answer your question, I will answer your question. I just want to ask, have you seen a typical annual account and report before?
Yes, sir.
You have. If you look at the annual
Yes,
account
but
and report, you have,
I've not read it.
you've not gone through it. Okay. Now, if you look after this class, Google, Google it, right? Google annual account and report of any company. In that, you're going to see the chairman statement. You're going to see report of the directors. You're going to see the report of the audit committees. You're going to see uh, sustainability report, or you call it ESG report, environmental, social, and governance report. You're going to see that report. Now, all of this information, they must speak to the what? Audit, to the financial statement that is embedded in the annual account and report. That's what it means, okay? So that is just it. Yes, let me see. Sir, you said that the audit report date must not be earlier than the date of what? Must not be earlier than the date the financial statements are signed. Must not be earlier than the date the financial statements are signed. So what I'm saying here, you look at the typical audit report, the financial statements that are included in the audit report, they are usually signed. That date on the statement must be what? The financial statement must be signed, and the date can the date of the audit report must not be a date before that date the financial statements are signed. Hope I'm going to answer your question.
Hello, sir.
Please go ahead.
Yes, sir. Item 6, audit opinion. You said that with if it's adverse or
Yes,
disclaimer, we should indicate
yes,
it. Is it through the
yes,
question we're going to know that this story is talking about disclaimer or
yes,
is
yes, yes.
modified or unmodified?
It's on the question. Since
Okay.
now you understand what can lead to a qualified audit report. You understand what can lead to a disclaimer of opinion audit report. You understand what can lead
Okay.
to an adverse audit report. That will tell you whether
Okay.
it is that. They're
Okay.
not going to tell
All
you in the
right.
question.
Okay. Thank you, sir.
You're welcome. Any other question? Okay, we are good. Let's continue. So let's look at some other aspects. Now, there are some other areas you also need to understand in the auditor's report. Okay, one of it is this area, emphasis of the matter paragraph. Emphasis of the matter paragraph. What do you mean by emphasis of the matter paragraph? Now, when you see the paragraph in audit report, one thing is that it is it's not a common feature in the audit report. That's why it wasn't part of the content. It's not a common feature. It's usually, if any. When you see emphasis of the matter in the audit report, what it means is that the editor is trying to further explain some aspect of the financial statement in the notes to the account. The editor is trying to what? Further explain some aspect of the financial statement in the notes to the account. Let me give an instance. So let's say, remember your CR, when you talk about subsequent events, that is adjusting and non-adjusting events, right? Now, let me give an instance. So let's say the year ended for the company is 31st December 2024. Now, and the report supposed to be out dated by March 2025. Let's say around February, there was a fire incident in one of their factories or one of their warehouses that affected their inventory. So the auditor will put a note under inventory, note 7. When you go to the note, the auditor will say that we were informed that fire affected one of our factories. What that implies is that, yes, we are done with the audit report for this year, but in the year 2025, you could have reduction in the balances of what? Inventory. And that reduction is as a result of this fire incident that happened or that occurred in February 2025. Please take note. You understand what I'm saying? So what that means is that data is telling you that Yes, the inventory for this year, 2020, under review, 2024 is fine. But when you get 2025, because in 2025, you are going to do comparative of 2024 and 2025. You now look at inventory, you know the inventory has reduced drastically. You don't need to ask any question. Why? Because the auditor has already explained in the last year's audit report that in the notes to the account that a fire incident occurred in one of the factory, and some of the inventories were what? Were destroyed by the fire. Do you understand? That's what we mean by emphasis of the matter. And that's what they explained here. This is what you have here. The purpose of this paragraph is to provide additional communication in the audit report where the auditor wishes to draw attention of users to a particular matter in financial statement. They do not modify the auditor's opinion. That is, they are not reasons for qualification. They don't form part of the reasons for qualification. The main reasons for qualification or modification of audit report, they are just two. Disagreement or misstatement, that is one. The number two, limitation of scope, that is two. I hope you understand. I hope we are together. So that is what this
Yes,
area
sir.
is talking about. ISA 706. There's another area we also need to look at. I'm going there now. Talking about the facts of the matter. Okay. Look at this. We have looked at limitation of scope. We have looked at all of this. Let me see if there's another area we need to look at. Before we go to question, we need to solve one or two questions before we close for today. I'm trying to see. Okay, there's no other area there. So there's other area that I want us to look at. And that area maybe is not covered here or somewhere is in between this note. It's called other areas you have there, you have material authority related to going concern. What do you mean by material authority related to going concern? Now, what we mean by that, I saw something relating to that here. Hold on, I'll show you now. This is it. There's something here talking about material authority related to going concern. What do we mean? Now, this is another section that is also contained in auditor's report. It is not always there. It is very rare. You hardly find it, but sometimes it can occur. When you have what we call material authority related to going concern, what that means is that, first of all, let's break it down. What do you mean by going concern? Going concern is an accounting concept that says that an organization will continue to exist into what? A foreseeable future. That is, an organization will continue to exist forever. It will not die. We call it going concern. But since the advent of IFRS, there's need for us to do what? To evaluate this going concern. There's need for us to assess going concern every 12 months. And that's what we carry on with known as what? Going concern assessment. The organization is expected, the organization is expected to perform going concern assessment. What do we mean by going concern assessment? So they will need to look at the organization. They will call on an expert. They will review the organization's activity and see, yes, the company can continue into the future. But for the next 12 months, can they survive due to some certain factors or challenges? So the expert will give his report. Now that report must be made available to the auditor when it comes to audit the organization, because you want to see whether the organization can still continue to exist for the next 12 months. Now, if the organization can still continue to exist in the next 12 months, there's no issue. That means, the financial statement is prepared on a going concern base, that is, with the intention that the company will continue to exist for the next for the next uh, for the next 12 months. Do you understand? The company will continue to exist for the next 12 months. I hope we are together. All right. But when but when the organization has any issue, when the organization has any issue that threatens the going concern or that has doubt on the going concern of that business for the next 12, what are those things that can lead to going concern issues? Number one, if the company is highly geared, the company is what? Is relying so much on what? Loans, long-term loans, or the company can no longer pay their salaries or cannot pay their contractors or suppliers of what? Raw materials. Okay? Or could be that one of their major customer will do their services. They don't want to patronize the company any longer. All of this can bring about situation for an organization. Now, the person that the expert that carried out the assessment is able to identify some of these issues, the auditor will now ask them, the management, what are you doing to these issues? They can now say, sorry, they are no, these are, for instance, let's say the company is highly geared, they are taking so much loan. Let's say that is the issue the organization has now. What the auditor will just do is just to ask them, how can you get yourself out of this problem? The manager will now say that, oh, okay, one of our options is that another company we are trying to merge with another company, and the company has promised to buy up all our outstanding loans. So that means if you come back before the next time you are coming, you will see that these loans would have been what? Would have been settled. So it does not pose any challenge, it does not cast doubt on the going concern of our business any longer. Do you understand what I'm saying? So the author will now say that yes, there was a challenge, that is the company had so much loans, but this challenge has been what? Has been resolved. How did they resolve it? They are going to merge with another company in a few months' time. And that company has promised, the company has agreed to buy up or to settle all the outstanding loans. That is what we mean by what? Uncertainty relating to what? Uncertainty relating to what? Going concern. Materiality relating to what? Going concern. Okay? That's what we mean by that. So what that means is that not that there was no issue, there was an issue, but that issue will not affect the company from continuing in operation. Do you understand? So that is what we mean by that. All right? So let's go on to any other question.
So what about
Any
the
question?
subsequent events, the number one? I think I've saw
Yes,
something like this in past
I
questions.
explained subsequent events now. All right? Now, what we are saying is this. I explained subsequent events in the course of trying to explain the what emphasis of the matter, and I told you my subsequent events. These are events that happen after the reporting date. We call them what subsequent events. And that's why I made the example of the inventory. The auditor has audited the company, and the year ended is what, 31st December 2024. Sometime in February, there was a fire incident in one of their warehouses that affected their what inventory. Yes, the auditors have completed their audit for 2024, but they need to include in the notes that, oh, in case of next year, when you see the inventory balance reduced from 10 billion to 7 billion, do not say that maybe there was fraud or there was something that happened, though. It was as a result of that fire that happened in February. So that is what we mean by subsequent events. So what that means is that because you did not plan for it, okay, you did not plan for it. So that is a non-adjusting event. You didn't plan for it. Do you understand? So in subsequent event, there are two types of events. You have adjusting events and you have the non-adjusting events. This one happened after the financial year end. So it's not like you are going to adjust your financial statement because it's not happening in the year under review. It happened after the year under review. And when you say an event is a non-adjusting event, it must be an event that happened after the year under review, after the reporting period. We call it a non-adjusting event. But if it had happened before the year, let's say there was a customer that bought an item from the organization around February 2024. He's supposed to have paid by March 2024, but he was duped. He lost his money. All through September, October, all effort to reach him prove abortive. You could not recover the money. We are sold to him. There is now a receivable in your books. What do you do in that instance? So you now got, so when the auditors came in December, you now heard that the man died in January 2025. What has happened? You had information about this. You knew about this prior to now. It didn't just happen. You knew that this man was duped. You knew that he was sick. You knew that he was unreachable for some months. So when you heard that he died, it did not just occur out of the blues. So you can make amendment, you can make adjustments into the financial statement in that regard. So that will qualify as what? An adjusting event, because you had an inkling, you have an information that speaks to that particular situation or circumstance before that time. So there is a whole lot of a whole world of difference between adjusting and non-adjusting events. I just need to explain what you mean by both of them, because I know that in your SBR now, you don't call it CR again. In your SBR, you are doing IS10. IS10 is where you have the subsequent event after the reporting date. Call it subsequent event. But in audit, we call it ISA 560. We call it subsequent event. But in SBR, we call it event after the word reporting date. How am I able to answer your question, madam?
Yes, sir. Thank you, sir. Well understood.
Any other question? Are we good to go? Let's continue. So, I'm coming. There's another aspect that we also need to look at now. Just hold on. Just a minute. Coming. Then the other thing I also need to look at, we call it key audit matters. We call it what? Key audit matter. It's under ISA 701. ISA 701. What do you mean by key audit matters? What do you mean by key audit matters? All right. Now, key audit matters are those matters, okay, that the auditor consider to be what? To be significant. The auditor consider it to be what? To be significant. And based on his own professional judgment, and they occur in the year under review. Let me take it again. Key audit matters are those matters that the auditor, based on his professional judgment, consider to be what? Significant. Okay? And they occur in the year what? Under review. We call them what? Key audit matters. Now, key audit matter, just like we explained emphasis of the matter and we explained material or sanity related to going concern, is also not a factor to qualifying auditor's opinion. It's not a factor. It's just a paragraph that sometimes appear in the auditor's report. We call it key audit matter paragraph. So when you talk about key audit matter paragraph, what are we looking at? So like I explained, right? Like I explained, right? I said that these are matters based on auditor's professional judgment are considered to be very significant, and they occur in the year under review, and they occur in the year under review. All right, they occur in the year under review. All right. So let me give an instance. What we mean by that? Let me explain. Let me give an instance. Somebody is asking a question. Yeah, let me see. What page? I said I can't find it here. I can't find it, but it's somewhere around here. Okay, it's somewhere around here. If I see it, I will let you know. Somewhere around here. So I will not be wasting time on that. But let me just understand it. I want you to have that understanding, because I don't know how the question will go. If this question come out and you get to see it, once I've discussed it in class, you can attempt it because you have an idea of it, okay? But it's somewhere in this material. So what I said is that, let me give an instance of what I mean by key audit matter. So I'll use the example to explain it. I said there are matters the auditor, based on auditor's professional judgment, are significant. What that means is that key audit matter, they are what? They are subjective. I might see a transaction or a circumstance or a matter as a key audit matter. And the auditor might say, no, this is not a key audit matter. It is subjective in nature. I hope you understand that. That's what you need to know. Number two, it must happen in the year under review. What that means is that you're auditing year 2024. That matter must occur in year 2024. If it happened in year 2023 or year 2022, it is not a key audit matter. It must happen in the year under review. Then number three, I said that it must be something that is what? Significant, most significant. Why is it so mean? Why is it so? Why is it most significant? It must be something that let us see it as what? Something that he needs to discuss with the what? With the users of the financial information. You understand now? Let me give an example. In 2018, Access Bank and Diamond Bank, they came together and became Access Diamond. In case you don't know, the year that Access Diamond was battered, that is the year 2018. Now, prior to 2018, Access Bank operated on its own, Access Bank, while Diamond Bank also operated on their own, Diamond Bank. Okay? Now, in 2018, they decided to come together and became Access Diamond. Now, when Access Diamond came together, there are some things they need to consider. Remember, for those of us that are using Diamond Bank prior to 2018, you know there's an account in Diamond Bank known as a Diamond Extra account, where they always announce a raffle draw, where they say that the winner will receive salary for life. That for life they are talking about here is just like, let's say, for 10 years. You keep paying the person some certain amount of salary for the next, on a monthly basis for the next 10 years. It's not for life per se, but that is the way they caption the price. All right. We don't have that account in Access Bank. That account, we don't have it in Access Bank. So when they came together, there's a need for us, first of all, look at, can they integrate properly? Okay, can they merge? Can the information in Access Bank and the information in Diamond Bank, can they be merged? Can they be merged? Compatibility. That's number one. Number two, the software, the banking software they are using in Access Bank, this is the same one they are using in the Diamond Bank. These are issues you need to consider. Number three, does any of these banks, do they have any contingent liability? Let's say a lawsuit that's yet to be decided, or a case that is yet to be decided. All of these are what they are going to look at together. Now, for us that are the users of financial information, you want to know how are we sure that this bank, there are issues that may pop up later on in future as a result of this merger. How are we sure that they have done the right thing? The only way we can show they have done the right thing is when we look at the audit report of the year 2018, when they merge. We look at a section in that auditor's opinion known as what? Key audit matter. There, you're going to see how the auditor treated those issues. And from there, you can now say, oh, the auditor has done a good job. We can rely on that information that the merger of these two banks were done properly. Do you understand? That's what we mean by key audit matter. It's under ISA 701. Key audit matter. Are we together? Any question? Any question? Any comment? Any observation? Let's look at another aspect before we look at the question now. We use the question to wrap up for today. I'm coming. I'm coming. Um, So we are still looking at audit report, right? Let's look at this aspect. Audit reporting and the Companies Allied Matters Act 2020, the reporting requirement of CAMA 2020. Okay. Now, if you go to CAMA 2020, you say that the reporting requirement of Company Allied Matters Act, section 404, subsection 1. The auditor of a company shall make a report to its members on the accounts examined by them and on every balance sheet and profit and loss account and on all group financial statements, copies of which are to be laid before the companies in the annual general meeting during the auditor's tenure. What they are saying here is that the auditor's report is usually discussed during the annual general meeting. Okay? Now, the fifth schedule of CAMA 2020 contains matters to be explicitly stated in the auditor's report. That is, look at the auditor's report. The following information must be stated in the auditor's report. Number one, whether the auditor have obtained information and explanation which, to the best of their knowledge and belief, were necessary for the purpose of the audit. That is, the auditor has been able to obtain unnecessary information, okay, sufficient and appropriate audit evidence to confirm that all information that is contained in the audit report can be what? Can be relied upon. Number two, whether in their opinion, proper books of account have been kept by the company and proper returns have been received from branches not visited by them. Now, when auditors go to audit a client's office, they don't audit all the branches. For instance, you want to go and audit a bank like Union Bank now, for instance. If you use 2 years, you cannot audit all the branches of Union Bank we have. The auditor will focus on some key areas, going to use what we know as either he use audit sampling or he uses what? Risk-based audit. Risk-based audit, or he uses what? Audit sampling. That's what's going to determine which of the branches of the bank is going to audit. And he must also ensure that those branches not visited by him, he must obtain a report from them. All right. Number three, he also needs to know whether the company balance sheet, and unless it is framed as consolidated profit and loss account, dealt with by the report are in agreement with the books of account. That is, if you look at the source documents, all the schedules, are they in alignment with the financial statement presented? That's what they are asking us. That's what they are saying there, okay? Next one. Whether in their opinion and to the best of their information, according to the explanation given them, the said statement give the information required by this act in the manner as so required and give a true and fair view. That is, what they are saying here is that all the information that is there, right, the auditor can give assurance that he has obtained all the necessary information that he believes would have contributed to him forming his own opinion, both as regards the financial statement, both as regards the balance sheet and the profit and loss account. Okay. The next one. In the case of a holding company, submitting good financial statements, whether in their opinion the good financial statements have been properly prepared in accordance with the provisions of the Act, so as to give a true and fair view of the state of affairs and profit and loss of the company and subsidiaries. It's still talking about the group structure now. We're looking at the consolidated financial statement. You want to be sure that all the information that you have obtained from all the components, okay, are in alignment. Okay, that is what this one is talking about. You look at components in group audit. Okay, we look at components in group audit. In your SBR, we call them subsidiaries. Okay, we call them subsidiaries in your SBR. But in group audit, we don't call it subsidiaries. We call them what? Components. So mind the way you use them when you are writing the exam. You are writing your SBR, you can call them subsidiaries. When you are writing audit, don't use subsidiaries. Rather use what? Components. It's the same thing, okay? Now, remember I said something about reports of the audit committee. This is it here. It's also contained, sorry, So it also contains a section in the annual account and report where the audit committee will make their own remarks about the financial statement that has been prepared, whether it's in line with applicable financial reporting framework or not. That is what is contained there in their own report. So in the auditor, in case of a public company, also make a report to the audit committee. The form and nature of the report remains somewhat discretionary as CAM 2020 does not prescribe the content or scope of the required report. The form and content of the report shall be agreed when agreeing the terms of the engagement and confirmed in the engagement letter. Okay, however, section 404, subsection 7 states that the objective of the function of the committee shall include ascertaining whether the accounting and reporting policy of the company are in accordance with legal requirements and agreed ethical practices. That is, what they said they want to do as documented in the accounting policies is what they are doing. Okay. They also need to review the scope and planning of the requirements. You need to look at the auditor's audit scope and audit plan. They also need to review the findings on management matters in conjunction with the external auditors and departmental responses thereon. Okay, what that means is that when external auditors go to audit the client company, they don't only limit their audit to finance and account department, they visit other departments. So if there are issues in other departments, they will need to write the head of department and expect them to explain reasons why things are not done as stipulated in their policies. Okay, so the audit committee can also assist the head of department in this area. The audit committee also keep under review the effectiveness of the company system of accounting and internal control. Also ensure that we have what system of accounting and internal control. Okay, and also make recommendations to the board as regards the appointment, removal, remuneration of external auditor. They are also responsible for whether to have to maintain the external auditors or to remove the external auditors or to increase his audit fee. Okay. They also authorize the internal auditors to carry out investigations into any activities of the company which may be of interest or concern to the committee. If there are fraud, if there is a fraud in the organization, they can ask the internal auditor to carry out an investigation into that fraud. All right. So with this, we are done with chapter 14. Let's look at a question. If you have any comment, observation, please do let me know before we look at that question. All right. If there are no observations, there are no comments, let's dive into that question. So for us, so that we can better understand, auditor's report. Okay. So this is a question. Let's look at this question. So you are the audit manager, you are the manager in charge of the audit of Coloroso, a limited liability company. The auditor's report for the previous year end, 31st December year 7, was signed without any modification. That is, you have an unmodified audit report. Okay. In February 2018, that is the following year, the scope of the audit for the year as at 31st December 20, as 31st December year 8 has been limited. This is because the company's chief executive officer fled the country in February year 8, taking the accounting records with him. Let me have you explain it one after the other. What that means is that the CEO of the organization carry away the financial statement of the company. Okay. You have identified a valuable training opportunity for Robin, one of your audit team. As a training exercise, you have asked Robin to draft the extract of the base of opinion and opinion paragraphs that will not be standard wording in an unmodified report. Robin's draft extracts were produced as follows, base of opinion. However, the evidence available to us was limited because accounting records were missing at the beginning of the year, and it's not possible to reconstruct them completely. All right. opinion, second paragraph, because of the possible effect of limitation in the information available to us, we do not express an opinion in financial statements. So what they are saying here is that the auditor of that company has asked one of their audit staff to prepare a draft audit report or some extract of the audit report, those things that we discussed, some content of the audit report that he wants to see because the guy is in training, they are training him. His name is Robin, they are training him. So look at the requirements. Identify and comment on the principal matters relevant to forming an appropriate opinion on the financial statement of Coloroso for the year ended 31 December year 8 and discuss the suitability of Robin's draft report. Look at the requirements. Identify and comment on the principal matters relevant to forming an appropriate opinion on the financial statement of what? Coloroso for the year ended 31 December 20, year 8. Well, let me explain what this one means. Now, let's say you're a typical exam now. You saw a question like this, right? You saw a question like this. You need to read and understand the question before you attempt the question. Okay? Like I always tell my students, if the question is not straightforward, let's say, what is an audit opinion or explain the type of audit opinion, you have a passage like this that has some questions. You need to read it like 3 times. The first 2 times, you need to read it. First time, you need to read it very fast, just to have an overview and understand of what that question is all about. Then number 2, you are going to read pretty slowly. It's not going to be as fast as the first time, but you're going to be a little bit fast. When you read it, you are reading with the understanding so that you can comprehend what it is about. Then the third time, you are reading it all over again. This time, you are going to read it together with the questions. The first 2 readings, please do not read them with your questions. Why? If you read them with the questions, your mind will be looking out for the answers, and some answers are not contained in the case study. They are, in fact, they are deduced. Okay? And if you have not understood it, you cannot deduce the answer. That's one of the reasons why I said you don't read the question until after the 3rd reading. You read the question. All right? Let's look at how this question has been tackled. Now, this is the suggested solution. So to answer the first one, they said, identify and comment on the principal matters relevant to forming an appropriate audit opinion on the financial statement of Coloroso for the year ended at 4 December year 8. Number 1, identify the principal matters relevant to forming an appropriate opinion. That's all you need to do, okay? You need to identify whether Robin's report indicate that Robin has identified and considered these matters. So let's look at the matters one after the other. Okay? Matters you need to consider. Number 1, the following matters are relevant to forming an opinion. Number 1, the accounting records for the opening 3 or 4 months of the year are missing. The man ran away in April. That means from January to April, you don't have that information. So you need to ascertain whether the accounting record for from January to April for the year are missing. Number 2, the accounting record are missing because the former CEO absconded with them. There must be some reasons why he took the accounting record. Fraud is a possible reason because he has perpetrated what? Fraud. 3, the audit opinion for the previous financial year was unmodified. This will imply that the opening balances for the current year and correct figure for the previous year are correct. However, this may not be the case. What we are saying here is this, because they said that the previous year, that was year 7, there was no auditor's modification in opinion. All right? So they assumed that the audit report was correct. But when you now saw that when you now compare it with that of 2020, I mean year 8, which the CEO has carted away or has taken away with him, you cannot be too sure whether that information is actually accurate. That is the opening balance, that is the closing balance for year 7, whether the one that was brought forward for year 8 was actually correct in the first place, because you don't have the basis for comparison any longer. Next one, you need to also look at if there is possibility of fraud. This would raise doubt about the correctness of the audit report of the previous year. there may be some fraud last year which were undetected. Okay, and this may have caused material misstatement in that audit report. That is, there could be a possibility of what fraud. All right. But what they are saying here is that probably it was not detected in year 7. Maybe the approach the auditor used that time will not detect whether there was fraud, because otherwise, what would have made the CEO to abscond with the accounting information in April year 8? All right. Then last one, there is an inability to obtain sufficient and weight audit evidence. That is, there's limitation of what scope. You don't have information from opening balance from year 8 to April year 8. There's limitation of scope. We don't have that information. All right. Then the next question they ask us is that we should look at, we have looked at, they say we should discuss the suitability of Robin's draft extract. That is, they asked Robin to draft basis for opinion and opinion paragraph in the audit report. We have read it before. So let's look at the solution. So here's the solution, okay? So Robin is correct to modify the opinion on the grounds of limitation of scope. However, the draft should make reference to the extract nature of the problem, that is possible fraud. Take account of a possible modification in relation to the comparative figures for the previous year, okay? Or take account of the fact that the problem may be limited to the statement of comprehensive income. So what they are saying here is this. What Robin wrote as an extract, if you look, let's go back to what he wrote so that you understand how to answer this question. Let's go back to what he wrote. I'm going there now. This is his draft extract. This is the draft extract. Basis for opinion extract. However, the evidence available to us was limited because accounting records were missing as of the beginning of the year, and it was not possible to reconstruct them completely. And this next on opinion, because of the possible effect of limitation of scope on in the information available to us, right? We do not express an opinion on the financial statement. What that means is that from what Robin put here, it did not envisage an aspect of what? Fraud. Okay? But it's a possibility. Because one of the things that can make the CEO to have absconded is what maybe he has perpetuated fraud, and his fear is that it will be what? It will be detected. That was why he ran away. That was why what? He ran away. So rather than to say that incomplete information, you can also put it there as what? Possibility of what? Fraud. And that was what they have captured in this solution here. That is, Robin is correct to modify the opinion on the gas division of scope. However, the draft should make reference to the exact nature of the problem, possible fraud. Take account of possible modification in relation to comparative figures in the previous financial year, or take account of the fact that problem may be limited to the statement of comprehensive income. So that is what we are saying there. That is based on what? Not the availability of what? Information, all right? Because of what? Fraud. I hope we are together. Any question? Any question? Any comment?
Oh, you see.
No, sir.
It's right.
Yes, sir.
No, sir.
Okay. No question? All right. Thank you. I'm trying to see if we can attempt another question. One question more before we go. I'm trying to see if I can fish out a question so that we can look at that before we go. So there's a question, May 2024. Let me share it with us. May 2024. Question in May 2024. Let's look at question number 4. Question 1 is also an audit report, but that could be lengthy because we don't have time. Let's look at question number 4. Question 4 is also lengthy, but we can quickly look at it. So this is question number 4. It's also an audit report. Demi Global Limited, that is May 2024. May 2024, AAA 2024. Demi Global Limited was a growth-oriented company that has been controlled by its managing director, Mr. Lunge. The company sells modern sophisticated mobile smartphones directly to the public. A large number of sales agents were employed on commission basis. The mobile phones were sent to these sales agents who then sold them directly to the public. The mobile phones were supplied to the sales agent on a sale or return basis. What that means is that the company is into what? Selling mobile phones. They sell to the public. But what they have is that they have a distribution channel. They use sales agents. So they sell to the sales agent and the sales agent sells to the public. And sometimes the sales agent can also return when they don't make sales, okay? They can return it. All right? That's what they are saying there. And Demi Global Limited recognized the sale of a smartphone when it was received by the sales agent. That is, once they give it to the sales agent to sell, that's when they recognize that they have made a sale, not to the public. Does that speak to IFRS 16? Does that align with IFRS 16 requirement? We'll get to know as we go on, okay? They said Demi Global Limited recognized the sale of mobile smartphone when it was received by the sales agent. Any return of the mobile phone were treated as repurchases in the period concerned. And when they return it, they capture it as what? Repurchases. That is, they bought them again. The company enjoys a tremendous growth record. The main reasons for this apparent expansion were Mr. Lunge falsified the sales record. He created several fictitious sales agents who were responsible for 25% of the company's revenue. Number 2, at the year end, Mr. Lunge dispatched nearly all his inventory of mobile phones to the sales agents and repurchased those that they wished to return after the year end. Number 20% of the cost of sales were capitalized. This was achieved by falsification of purchase invoice with the cooperation of the supplier. 20% of the cost of sales were what? Capitalized, which were achieved by falsification of purchase invoices with the cooperation of the supplier. Supplier furnished the company with invoices of non-current assets, but supply mobile smartphones. Number 4, directors of the company enjoy a bonus plan linked to reported profit. Executives could earn bonuses ranging from 50% to 75% of their basic salary. All right. What that means is that it's what they reported. It's from there they are going to pay the directors as what? As dividend, okay? Or fees, directors' fees, okay? The directors did not query the unusual rapid growth of the company and were unaware of the fraud perpetrated at Mr. Lunge. Mr. Lunge spent large sum of money in creating false record and bribing accomplices in order to conceal the fraud from the internal audit department. He made effort to cover up the illicit activities and precluded the auditor from corroborating sales with independent third parties and from examining the service contract of the directors or discussing the affairs of the company with the sales agent. The external auditors was sued by a bank that had granted loan to Demi Global Limited on the basis of independent financial statements. These financial statements had been reviewed by the auditor and a review report issued. Required, discuss the extent to which the auditor is responsible to detecting fraud and error, and external auditor's procedure when fraud or error is detected. Number 2, advise the auditor on strategies to close gap. Number C, explain how the review report issued by the auditor on interim financial statement differs in terms of its level of assurance from auditor's report on the year-ended financial statement. Evaluate circumstances and nature of the report that would have been necessary for the auditors based on the activities of the managing directors. All of these are what? 20 marks. Let's go to suggest solution because of time. You have seen the question. Let's go to the solution because of time. We are looking at question 4. So the first question is looking at what's the responsibility of the auditor to fraud. Now, the auditor has a legal and regulatory responsibility to reporting whether the financial statement show a true and fair view of the financial position and performance of the client. He is therefore only concerned with fraud and error that has a material effect on the true and fair view. The auditor's responsibility is to obtain reasonable assurance that the financial statement taken as a whole are free from material misstatements, whether caused by fraud or error. It is not the primary responsibility of the auditor to prevent or detect fraud or error. Therefore, the audit may act as a deterrent to fraud. Auditors may also discover fraud or error during the course of their audit work, but they are by no means certain to do so, whether errors or fraud has occurred. It must be recognized that some material misstatements caused by fraud or error may go undetected because of inherent limitations in any audit, and the fact that deliberate attempts may be made to conceal fraud from the auditor. All right, that's the answer to that first question. That is, the summary is that the auditor is not primarily responsible for the prevention and detection of fraud. However, in the course of performing his audit, he must also try to ensure that he detects fraud. Okay, but he is not responsible for the prevention and detection of fraud. Rather, is the management that are responsible for the prevention and detection of what? Of fraud. Okay, that's the first one. Second one, talking about the audit procedure for fraud detection. That is when the fraud is detected, what are the audit procedures the auditor should carry out? And these are what we have here. Number one, primary responsibility for the prevention and detection of fraud rests with those charged with governance of the entity. Okay. The auditor conducting an audit in accordance with ISA is responsible for obtaining reasonable assurance that financial statements as a whole are free of material mistakes, whether caused by fraud or error. Okay? Then these are the steps the auditor should need to do when he detects fraud. You should identify the extent and possible impact of the financial statements of the fraud or error. Document the fact fully in the audit file. Additional testing may be required, okay, to establish the likely effect of any misstatement. Number two, consider the possible impact on other areas of the audit on the overall assessment of audit report. This may result in a revision of the original. That means we need to reevaluate his audit strategy, audit plan. Then the findings should be discussed with the management, regardless of the extent of the problem. And the management should be kept informed of development, okay? Then number next, the auditor should determine the actions that management should take, okay? That is, it should include the possibility of seeking legal advice if the fraud is suspected. The auditor should normally communicate on a formal basis. And if the management is unable to resolve it, right, the auditor should normally communicate on a normal basis to management at an appropriate level. In the case of what? A public interest entity. The auditors communicate formally with the board of directors or audit committee. However, the management themselves are involved in a suspected fraud. The auditor should consider taking legal advice to decide the best course of action. In the same cases, the auditor may feel it is appropriate to resign. Next one, the auditor should consider the impact of his audit report to the shareholders in terms of any impact on the true and fair view presented in the audit report. Okay? You can see that most of these things we have looked at it in previous chapters. Okay, this is not audit report, but we are looking at the audit procedure when the fraud is suspected. Fraud, we look at fraud and error in chapter 4. Okay, so go back to your notes or go back to your recording on chapter 4. All right, now the B part, to reduce the frequency and cost of legal action and to maintain the image of the audit profession in the mind of the police. Is talking about the expectation gap. Okay, it is in the interest of the profession to take steps to close the execution gap. What are the strategies? Number one, the audit profession should attempt to improve the general level of knowledge and understanding about the audit process. One of such attempts has been made with updates to the audit standard on auditors report as published by IFAC in 2015. This update enhanced the auditor's report to make it more relevant and transparent to users. For example, by introducing a new section on key audit matter, which we have discussed, okay, more relevance, more requirements with regards to reporting going concern. And going concern, we also look at that, okay, and improve description of the responsibilities of the auditors. Control over the auditing profession are important in enhancing public confidence, okay? Significant guidance on auditors and management aimed at increasing the quality and addressing issues such as going concern has been issued by the standard setters, professional bodies, and regulators. There has been an increased focus on corporate governance and the role that audit committee play in companies, reducing inconsistencies and enhancing quality. Okay. Then these are other aspects of looking at the execution gap. Yeah, the question is I'm looking at time, right? The question is May 2024, question number 4. So take time to look at it, okay? So with this, we have come to the end of the class today. All right. So I've given us the question. It's May 2024, question number 4. You have the Pathfinder, check May 2024, check the ESA solution, and you'll be good to go. So we are done with this class, okay? Audit report. Any question, comment, observation?